In 2018, the average monthly payment for a mortgage was $1,250. Today, the average mortgage costs about $2,200. During that same period of time, we've seen personal interest payments almost double. They now stand at a staggering $500 billion. People have come under rapidly increasing financial pressure over the last year, and we see that clearly when we look at data on consumer delinquencies that have been rising at the fastest pace since 2007. Now, on a relative level, these delinquencies are lower than they were at the peak of the 2007 madness, but a quick extrapolation of the recent trends shows us that if things continue going as they've been over the last year, consumer delinquencies could reach 2008 levels by early next year, which essentially shows us the number of people that are defaulting on their debt obligations. All of this is a result of the Federal Reserve raising interest rates over the last couple of years. We clearly see over time that delinquencies tend to rise following periods where the Federal Reserve has raised interest rates. The Fed keeping interest rates at the highest levels since 2008 is currently suffocating the economy. When the Federal Reserve raises its interest rate on short-term loans, it leads all interest rates around the economy to rise, like mortgage rates, but also corporate debt interest rates, and even credit card interest rates that have recently surged to the highest levels ever over the last year. So it essentially becomes more expensive to borrow money for corporations, for individuals, and even the government. And in a credit-based economy, that leads to economic downturns almost every single time. An increasing number of economists in recent months have begun calling for the Federal Reserve to cut interest rates as we've seen an increasing amount of economic weakness. The big debate today is not whether or not the Federal Reserve is going to cut interest rates, but how much the Federal Reserve is going to cut interest rates, and more importantly, whether these rate cuts could actually prevent a recession from occurring in the United States, or whether the damage that we've seen from interest rates being so elevated has already sown the seed for a downturn to occur over the next year. By the way, a quick reminder, we're changing our name to Bravos Research. We've had a fantastic fun ride with the Game of Trades name, but for reasons that I cannot disclose in this video, we are changing our name to Bravos Research. So make sure you note that down and turn on the notification bell if you want to continue watching our videos. The Federal Reserve has two official mandates: price stability and full employment. And while recent data has reassured many people on the price stability front, the Fed's full employment mandate has increasingly come under question. The unemployment rate in the United States over the last year has risen at the fastest pace since COVID, and before that, the 2008 financial crisis. And Jerome Powell, the head of the Federal Reserve, has suggested he does not want to see any further cooling of the labor market today. He said,
"It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in labor market conditions."
Which clearly means that if they do see weaker labor market conditions, they will have to cut interest rates. Now, he said this last month at the Jackson Hole meeting, and since he had said this, we've continued to see weak economic data on the employment front. An ADP employment number and a non-farm payroll number both showed that the U.S. economy had added the smallest number of jobs since the pandemic. Now, a month ago, financial markets were betting that there was only a 10% chance that the Federal Reserve was going to cut interest rates by a full percentage point by the end of the year, like you see on this chart. Now, the probability of this scenario occurring, according to financial market data, is 40%. So interest rate cuts are coming, and financial markets are finally waking up to that fact. The question now is whether these rate cuts from the Federal Reserve will be enough for the U.S. economy to avoid a recession, something that they failed to do in the last 3 times. The only time where the Federal Reserve actually was able to pull that off was right here in 1995, where after big rate hikes in 1994, the Federal Reserve cut interest rates just in time to avoid a recession, and the economy continued to hum along all the way up until 2001 for another 6 years. When we look at the U.S. stock market index, the S&P 500, it certainly seems to think that the U.S. economy can avoid a recession. In fact, that is seeing similar returns to this 1995 to 1996 period. A trend, by the way, that we've been able to help our clients benefit from over the last year. We sent out multiple buy alerts for different stock setups that we like to our members during these dips. We had some fantastic opportunities to trade during this bull run, with our members getting 44 winning trades so far in 2024 on stocks, commodities, and an average profit of 16%. If you want to get access to all of our trades, our entire equity strategy, make sure to click the link in the description below to learn how to become a member. We absolutely cannot guarantee that we'll continue to perform this well, but I can tell you that we'll continue to work day in, day out to make sure that's the case. But just because the stock market has been strong over the last year doesn't guarantee in any way that the U.S. economy can avoid a recession. At any point over the next few months, we could see equity markets turn around and begin to price in a recession. If we go back to the chart of consumer delinquencies that we looked at the beginning of this video, and we add the federal funds rate on top again, we see something very interesting. The Fed's interest rate leads delinquencies by a full year and a half. So the high interest rates that we have today will likely continue to push consumer delinquencies higher until well into 2025. And unfortunately, any rate cuts that we get today likely won't be felt by the actual economy until late 2025. One of Milton Friedman's most famous quotes is that monetary policy has long and variable lags. And since he said this, academic research has proved him correct. There's around a 14 to 18 month lag between monetary policy and the impact on the economy, which means that between now and around mid-2025, the US economy will likely continue to deteriorate and, in our opinion, head towards a recession. This is why we sent buy alerts for gold mining stocks in November of 2023, and why even after a plus 50% move in these stocks, we continue to this day to be aggressively long on precious metals. But why on earth are US stocks also doing so well? With US stock market valuations now reaching record levels, it seems that as far as Wall Street is concerned, everything is going very well. In the meantime, consumer sentiment is depressed to the lowest levels since the financial crisis, and before that, the 1970s, periods that saw significant drawdowns in stocks and much lower valuations than today. As you can clearly see from this chart, what we've witnessed over the last few years is extremely unusual behavior, what you could clearly label as being a K-shaped recovery that we've had since COVID. If you're anything like the average American, you probably believe the current valuations of stocks are absurd. Now, we don't believe this is just going to gently resolve itself on its own. We think a shock is coming, and that will revert the market back to the reality of the economy. We highlight all the details of this at gameoftrades.net. If you believe we're seeing this correctly and you want to benefit from the massive economic and financial shifts that we're going to witness in the coming years, sign up to our membership and we'll do everything to make sure that your investing and trading journey are as prosperous as possible looking forward.